Hey guys, this is Sebastian Guerra, president and partner here at Guerra Wealth Advisors, where we help our families get to the point where work becomes an option and not an obligation. Today we're going to be talking about a very unique strategy where you can save almost over $1 million in taxes just by implementing this one tax strategy. And this is a strategy that can be used across the board. It doesn't matter if you're 40 years old, 50 years old, 70 years old, 80 years old. It doesn't matter the age. This is one strategy that many people can implement if they're looking to sell any investments that have gone up in value a lot and they're looking to save money in taxes. If you really like the subject of retirement, taxes, investing, estate planning, long-term care planning, asset protection planning, please make sure that you subscribe to this channel. Every single week I put out a new video where we talk about all of these different subject matters so that we can make better decisions with our money, especially as we're entering the stage of retirement. With that said, let's talk about a very powerful strategy called the CRT. It's called a Charitable Remainder Trust. And this one strategy was able to save this lady over $1 million in taxes. So just a couple months ago, I ended up meeting with a lady. Her name is Melissa. She right now operates as what's called a real estate manager. So years ago, her husband had passed away, left her a property that her husband had bought almost over 40 years ago. And she was the 100% heir of this property. She's right now 60 years old. She's eventually going to be getting at 67 her Social Security check of about $28.50. She doesn't really work today except mainly being the real estate manager for her property. She's got about $250,000 sitting in a couple bank accounts, but her primary asset is one property. She has an apartment building with about 40-something units, and it's worth about $6 million. And this property is generating almost about $600,000 in rent every single year. But now off of that, you have to also subtract, the property taxes and the maintenance and insurance. And she's profiting somewhere around $250,000 a year, which is about $20,000 a month. But her worry and her stress came from, dealing with all these tenants over the last 10, 15 years since her husband had passed away. And she was kind of just telling me, look, I'm done with dealing with all these tenants. And I think that one of the challenges that a lot of people as they're entering retirement is that they might have a lot of money in real estate, they might have a lot of rental properties, but the question of, do I want to still be a landlord as I enter the stage of retirement? Do I want to be getting those phone calls late at night, or am I going to go and delegate that out to a property manager? And so she was kind of at a point where she's like, look, I'm done with it. I've been a property manager for years. I just want to be able to enjoy my retirement. But the problem is that if she turns around and sells the property, there's some very big tax consequences. So what I want to go over right now is the tax consequences of selling a investment property that has gone up in value. So if you right now have an investment property or you have an asset like a stock that's gone up in value and you want to be able to sell it, but you are scared of the taxes that you're going to have to pay, well, I'm going to go over right now exactly how you can sell those investments and potentially be able to avoid a large percentage of all of those taxes that you would need to pay. So this lady, she had purchased this property years ago with her husband. The property, when they first bought it, was worth about $1 million. Today, it's worth about $6 million. And when you normally buy an investment property, you normally take something called depreciation. And so she had taken about $800,000 of depreciation off the property since they originally purchased it. And the land in itself was only worth about $200,000 because when you're buying a property, you're not allowed to depreciate the value of land. You're only allowed to take depreciation on what's called the value of the actual building, the actual structure. So she was able to deduct $800,000. But now, here's the challenge, right? If she turns around and sells this building of $6 million, well, what are the tax consequences that are going to come from that transaction, from that sale? So here's the way it works, right? So the first thing that we need to understand is something called depreciation recapture tax. And what that simply means is that when you have a property that you've depreciated in value over the last 10, 20, 30 years in her case, anything that you have depreciated, in other words, you've taken it as a tax deduction off your personal income tax, all of those deductions, once you turn around and sell it, you need to pay approximately 25% of the amount that you depreciated. So what does that mean? If you sold the property and there's $800,000 of depreciation that was taken over the last 30 or 40 years, and now you sell the property, well, there's about a 25% tax on the $800,000, which equals about $200,000 that would have to be paid if she decides to sell the property. But that's not it. There's more tax that she would also need to pay. Well, there's another thing called capital gains tax. And what that means is that if the property is sold for, say, $6 million and the adjusted basis is $200,000, which just pretty much means that's the land value, then that means there's a $5.8 million capital gain. And when you do the math, the $5.8 million being charged 20% in capital gains, that's $1,160,000 of capital gains tax that would need to be paid. Now, there's this other rule, which called the net investment income tax, which is an additional 3.8%. And what that means is that now there's $220,000 that would have to be paid because the government just likes to tax assets that are sold above a certain amount of money. They like to tax them an additional amount, and that's an additional 3.8%. So when you begin to add up all of the capital gains, it's $1,160,000 plus $220,000. That gives us a grand total of $1,380,000 in just capital gains. So if you go down here and you're like, all right, well, how does capital gains work? Well, in this scenario, it's 20%. Then the net investment income tax is 3.8%. You begin to add this up, and this really adds up to a significant amount. And if you look at this right here, the depreciation recapture, we said it was $200,000. The capital gains tax is $1,380,000 for a grand total of $1,580,000. So the challenge that a lot of people run into is that they kind of get stuck with their property. They're like, wait a second, I got this $6 million property. I'm tired of dealing with the tenants. But if I turn around and I want to sell this property, I got to write a check of $1.5 million to Uncle Sam. So people kind of feel stuck. Now, a lot of people have heard of this strategy called the 1031 exchange. It's a very common strategy. A lot of people know about it. I'm not going to talk about that today because the 1031 exchange, in simple words, what that means is you have to sell your property, and then you have to grab that money, and then you have to go and invest it into another property. And that's how you can avoid paying the tax. But you're still exchanging one problem for another problem. In her case, she was done with real estate. She's like, look, I want to get my money out of real estate and try to figure out a way on how to avoid paying the tax legally without me having to go and buy another property. And you see, most real estate agents, they're always going to tell you, do a 1031 exchange. You know why they're going to tell you that? Because they're going to make commission on that other sale as well. So they're going to help you sell property number one, help you get out of it. Then they're going to grab that money, help you buy property number two, and then make a second commission on that property. So that's why most realtors will always tell you that a 1031 exchange is a great strategy to help you avoid taxes. But in reality, they're just helping you get out of the problem that you want to get out of to get into another problem, which is the same problem that you're trying to get out of. And I think that's where we have to ask ourselves, well, is there another plan? Can we do something else that can help us get out of this property and be able to avoid the tax? And that's where we can talk about what's called the Charitable Remainder Trust strategy. Now, I will give them a benefit of the doubt. I would say that the majority of these real estate agents just probably don't even know about these more advanced strategies. And usually at their big brokerage house, they're always talking about the 1031 exchange. But today in this video, we're going to talk about another strategy that probably your own real estate agent doesn't even talk to you about, and even probably your own accountant that's supposed to know a lot about taxes and about tax strategy, he might not even know about this. If you're enjoying these types of tax strategies like a charitable remainder trust, I've actually created a 125-point tax planning checklist, which, by the way, most tax strategists will literally charge thousands of dollars for this list. And a lot of tax strategists, this is the list that they use to help implement tax strategy for high income earners. So if you are looking for ways on how to minimize taxes, I'm actually giving away this free PDF where it goes through all 125 tax strategies. You can use this PDF to help you minimize your taxes all throughout retirement and also throughout your working career. If you want to download this free PDF, you can text me to 786-807-7001. You can just text me the word money. I'll send you right back a link where you can download that PDF. And now you know exactly the strategies that you could be using to help you minimize taxes now and also throughout retirement. So before we jump into the strategy, I do want to make a quick disclaimer. Number one, before you implement something like this, you need to make sure that you have an attorney that knows how to draft up legal documents like the ones I'm going to talk about. And you also want to make sure that you're working with a financial planner that also understands the investment component as well. So it's very important that you work with these two people together, because this strategy could save you literally hundreds of thousands of dollars. And even for some of you, it can be millions of dollars, but this needs to be worked together with these two very important professionals to make sure that it's all drafted up correct. So this lady, as I mentioned, she had about a $6 million property. The first thing that we want to do is we want to create what's called a trust. Now, it cannot be any type of trust. It's what's called a charitable remainder trust. And this is why you want to make sure that you're working with an attorney that understands how charitable remainder trusts work. Now, how do they work? I'm going to go over it right now. As soon as you go to this attorney, you're going to tell him, hey, look, I would like to create this set of documents, this specific type of trust. Now, charitable remainder trust, normally what you do is when you meet with the attorney, you create what's called a distribution plan. So as we mentioned earlier, this lady has a $6 million property. So the first thing is, once you know that you want to sell this property, you want to make sure that you go find yourself an attorney that specializes in what's called charitable remainder trust. And they have experience in creating these specific types of trusts. Now, once this trust paperwork is created, in that paperwork, you're going to want to make sure that you create what's called a distribution plan. Now, what is a distribution plan? It's literally telling that set of documents that says exactly how you want to distribute the money from the account based on your rules, your conditions that you have instructed your attorney to put into your paperwork. So you can say something like, okay, all of the money in the trust, I want it to be distributed to me over the next 5 years, over the next 7 years, over the next 10 years. You have to select what's called a distribution plan. And once that distribution plan is set, it is set in stone. It cannot be changed. So the first thing is you're going to draft up this paperwork with your attorney. Once that paperwork is drafted, in that paperwork, you will also create a distribution plan of how many years it's going to be before the funds in that trust are completely exhausted. Once that distribution plan and that trust is created, you now want to donate the property into the trust. What you're doing is you're removing yourself as the owner and you are now donating the property into the trust. And what that means is now the new owner of the property is not you anymore. It's not your LLC. It's now your trust. Your trust owns the property. So now what's going to happen is now you're going to go to the day of closing. You're going to go and try to sell the property. And at the title company, when they're about to issue you the check of $6 million, when the check is about to be issued, the check is not issued to your personal name. The check is going to be issued to the charitable remainder trust that you have created. But where is that $6 million check going to be deposited? And that is why it is very important for you to select what's called a custodian, a financial custodian. There's a lot of institutions out there that are financial custodians. We personally at our firm, we primarily focus on Fidelity Investments as the main custodian. There's a lot of great custodians out there like Morgan Stanley or Vanguard or Charles Schwab. But you want to select a specific custodian so that way the day that you go to the closing table and they're about to issue the check doesn't get paid straight to your name. It's getting paid into the charitable remainder trust, but that trust has to be created at a financial custodian, say Fidelity in this example. So now the $6 million check will go straight into that custodian. In this case, let's call it Fidelity. Now, once the money goes in here, the great thing is that you can still invest this money however you want inside that account. So you can invest the money in stocks, bonds, mutual funds. You can invest your money inside that account. But remember what we said is that this money will be distributed to you based on the distribution plan that you previously created with your attorney. Here is where it gets even more interesting. Once the money goes into the custodian, you technically have avoided the tax entirely legally. You did not have to pay the tax. So the check, the $6 million check, goes straight into this account. And now from there, you now begin to distribute the money based on the distribution plan you previously created. Now, remember, every time you make a distribution out of it or you get that check, you do need to pay taxes on the amount that you're getting, and it's all in proportion to the capital gain, but a piece of it is going to Uncle Sam. So you're not avoiding entirely the tax, but if you're distributing a certain amount of money and probably you're getting into, say, the 15% capital gains rates versus originally you were going to be in the 20% or the 23.8% with the net investment income tax, when you factor those elements in, you're probably going to pay way more money in taxes. So by you just shifting all the money into your custodian, your charitable remainder trust, and maybe making distributions of a specific amount under a certain limitation, you can now fall into a lower tax bracket, and now you're paying less money in taxes every time you get money. But the great thing is you still have full control over the money inside the account. Now, you might be asking, well, what does the word charity mean in the word charitable remainder trust? And what it means is that a portion of the money that is inside your charitable remainder trust must go to charity at the end of the life of the trust. So if your trust is, for example, a 10-year trust where you have a 10-year distribution plan, on the 10th year, once it's done, a portion of the money must go to charity of your selection. But that amount of money can vary depending on a lot of factors. But for most people, it's anywhere between 5 to about 10% of the original deposit that went into the trust. So meaning that if I have $6 million property, that means anywhere between 5 to 10%, which is anywhere between $300,000 to $600,000, must eventually go to a charity of your choice. But here's the beautiful thing. The moment that the charitable remainder trust is created and the property is donated into the trust, you're able to get a tax deduction for the donation that you made into the charitable remainder trust, even though the funds have still not been distributed to the charity yet. So the idea is that as soon as the money goes into this trust and as soon as the property goes in there, you'll be able to deduct that $300,000 to $600,000 off of your personal income tax. And at the end of the life of the trust, at the end of the distribution plan, now the funds are going to be distributed to that charity, but you got a tax deduction now. You're able to avoid taxes throughout your entire distribution plan, a large amount, and you were still able to help your church and help you significantly when it comes to taxes. You see, just this one little strategy can literally save you over $1 million in taxes if it's properly implemented. The problem is that most people, when it comes to the subject of money and retirement and investing, most people think it's pretty simple, but it could be more complex. But there's a lot of ways to be able to save a lot of money in taxes when it's properly set up. So as you can tell, there's many strategies that a lot of millionaires use, especially when they're working with really good tax strategists. If you right now know someone that makes a good amount of money that you probably think they're paying too much money in taxes, if you can just grab this video, just send it straight to them. There's going to be so much value that they can get out of it. Or maybe an individual that you might know that has a property or maybe has some stocks that have gone up in value and they're trying to figure out ways on how to minimize their taxes if they decide to sell tomorrow. This is a phenomenal strategy that could be implemented. So just grab this video, send it over to somebody that you really care about. That way they can be in a better position than before. Take care.